Hello, everyone, and welcome back to the session on mutual funds. Now, we move on from understanding the different types of mutual funds. The first one being the portfolio funds, or the classification based on the portfolio of the mutual funds. Among these, we should first discuss about the bond funds. Now, bond funds are such funds wherein the investments are basically made on the fixed returns for safety. These funds are more liquid in nature, diversified, and conservative investments. As the name says, the primary objective of these funds is safety and liquidity. So, these are the investments which are made into conservative investments, and therefore, the returns on the bond funds is of very modest capital nature. The second type of funds are the stock funds. Now, stock funds are those funds which have been established for those who are ready to take up significant risks and they have an aspiration to get very high returns. These are the common type of stock funds, and these are held into different types of diversified industrial corporations. Based on the diversification, these funds may further be divided into income funds, growth funds, and money market funds. Now, what are the growth funds? Growth funds are those wherein the major objective of investment is capital appreciation for the investor over a period of time. And these funds are basically entrusted into equity stocks which give a more than above average growth potential. Thereby, there is an implicit high risk on these investments. However, there is a potential for making gains of higher than the current market. Next, we speak about the money market funds. Now, money market funds, as the name says, is more entrusted to investments into money market assets, as in short term liquid assets or certificates of deposits or commercial papers. Now, these are the investments of being made into public investments, and they are high liquid asset funds with a very low risk and virtually no capital loss on the face. However, these funds do have a very high service charge. Next, we move on to understand about the leveraged funds. Leveraged funds, which are also known as borrowed funds, are used in order to increase the size or the value of the portfolio, thereby benefiting the shareholders by making gains at the cost of the borrowed funds. So, leverage funds are basically funds which are entrusted in order to increase the size or the value of the portfolio and benefit the shareholders by making gains exceeding the cost of the borrowed funds. Now, these funds are also of very high risk and speculative in nature, and there are also opportunities for short sales and thereby making advantage of the declining size of the market. We move on further to understand about balanced funds. Some mutual funds are also known as balanced funds. Now, these assets are justified or a judicious mix of industrial stocks as well as bonds. And the objective here is to secure reasonably good rate of interest with a modest level of risks. Now, these are like the investments into high grade common stocks of about 25 to 40% and conservative stocks up to the balance of 60 to 25%. So, this is about the balanced funds. Next, we speak about the portfolio classification of mutual funds. And we speak about Two other types of mutual funds, which are special funds and index linked funds. The special funds are the funds wherein the investments are entrusted only into specified channels like gold or silver, and only, or it could also be into a specific country, say Japan fund, India fund, etc., or into a specific category of institutions or corporations, say it could be into technology, the IT sector, or a pharma sector. So special fund speaks about investments into a specific type of channel. Next, we speak about the index linked funds. The investment of these funds are only among the shares which are listed into some index. That would naturally mean that the value of these funds are then highly correlated with the movement or the changes of the indices. So these funds may move up as the index moves up and move down as the index moves down. Next, we speak about the dual purpose funds. These funds maintain a balance in the investments with regular income as well as the growth opportunities. So, thus, these funds are received and then pooled together and used in an investment to derive a portfolio income for investors who want to hold income shares, and the investors who hold the capital shares receive no income, whereas those who receive the income share may receive a part of the investments from their portfolios in the form of capital gains. The last one is a real estate fund. Now, this is a closed end type of a fund, and it is named so as the concentration of the investments of these funds is more into real estate. So, that was about the classification of mutual funds based on the portfolio of a portfolio or the investments being made by the mutual fund companies. Thank you so much, and I would wait to see you all viewing my next video on the functional classification of mutual funds.